Hi, everyone. Welcome back to another episode of All the Wealth, more on markets. I'm Matthew Levy, portfolio strategist, and it's July 10th today. So we're well into the second half of what's been an eventful year, to say the least, for markets and for investors, of course. And today, I want to talk about three things: some pretty encouraging numbers out of the June jobs report that we just got about a week ago, the latest round of the ongoing tariff drama that we've seen, and what you should kind of expect for the second half of this year, and a little bit on why corrections like we had in April are normal and shouldn't scare you. So let's jump right in. Let's start with that positive news we got last week from the June jobs report. There's plenty of uncertainty going into the numbers, especially given the government cuts that we've seen, people thinking that we might see employment push significantly higher. But the US unemployment rate actually declined from 4.2% in May down to 4.1% in June. This reflects a pretty stable job market given the kind of uncertainty we've seen. And a significant number of unemployed people are actually able to find new jobs. So great news. It matters for you as an investor because unemployment's a pretty key indicator of the overall economy in the US. When more people have jobs, there's more spending, there's more economic activity, and ultimately can lead to stronger markets. So the fact people are still getting hired despite all of this news and all of the tariff uncertainty and the political drama that you might be watching on TV every day. The economy is it's not ignoring all of these things that are going on, but it's handling it quite well. So that's the kind of good news we like to see. And let's shift gears and talk a little bit more about what's happening on the tariff front. There's been some drama here lately, obviously. Initially, President Trump and the administration set July 9th as the deadline for a number of trade deals to be reached. Otherwise, there was going to be a big tariff hike that he announced earlier in the year on those so-called Liberation Day tariffs, which is why we're recording this on July 10th, because we thought we'd have something like that to discuss in more detail. But of course, we've seen he's pushed that deadline out to August 1st. This is going to change every day until then. Where he sent out letters to countries like Japan, South Korea, Thailand, and Brazil, threatening tariffs anywhere from 20 to 50% if the agreements aren't reached by then. So just trying to kind of ignite those trade talks, make them move a bit faster, put some pressure on. These tariffs do matter for a couple of reasons. One is the uncertainty that we've seen, which causes volatility in the markets. Second is that if those tariffs are enacted, it can push prices higher here back at home, potentially hurting consumers and slowing economic growth. As we've seen, the markets have been pretty surprisingly resilient to all this uncertainty. We've seen volatility, sure, back in April, but the markets are right back near all-time highs, and it's kind of showing investors aren't really panicking at this point in time. Still, keep it in mind, you'll probably see some ups and downs the next few months as this story unfolds. Uh, Speaking of ups and downs, let's take a quick look back at kind of what's happened in the first half of this year. 2025 started pretty strong. Everything was going good. And then April happened. We saw the market take a really sharp downturn on those Liberation Day tariffs that I mentioned. The market dropped almost 19%, mostly driven by trade and geopolitical tensions. But the market bounced right back in one of the most astounding recoveries that I've seen, at least in some time, like outside of 2020 COVID rebound. I can't think of another time where the market bounced back this fast and this high to new all-time highs. Looking ahead to what's going to happen in the second half of 2025, we're still expecting volatility. It never goes from the bottom left to the upper right in a straight line, especially with all the issues on the horizon. But remember that volatility is quite normal. Corrections aren't a sign that something is wrong. In fact, they can be healthy for stock markets to go through a correction once in a while. And it's really just part of the risk and return equation that you kind of agree to implicitly when you invest in stock markets. That brings me to a pretty important point I want to close on today. And that's that market downturns, corrections, pullbacks, whatever you want to call them, they happen almost every single year. According to Charlie Bello at Creative Planning, going back to all the way back to 1980, the average yearly drawdown for the S&P 500 has been around 14%. Some years it's more, some years it's less. Some years the markets end down, some years, and most of the time markets actually end up for the year. But what that means is on average, markets will temporarily fall 14% from their high to that bottom at some point throughout the year. So this year's dip back in April to 19% drawdown, it was uncomfortable for you, for me, for all investors, but not unusual. So despite those downturns, we've seen the market bounce back again and again and deliver strong returns to those who stay invested. Investing in stock markets, it's not about picking the right time or knowing exactly what you want to do. It's about riding that wave to kind of get to where you need to be. So, you're probably going to have your boat rocked at some point, and we all do, but it doesn't stop you from getting to where you need to be. And in fact, a lot of the time, those short-term risks, they create good opportunities for those looking for longer term rewards. Anyways, the quick takeaway from today's market update, the job market's strong right now. The economy's looking pretty resilient. Tariffs are a messy thing to deal with, but there's no way to kind of forecast what we want to do until we get more clarity. And in reality, we're just going to want to stay invested anyways. And then corrections, like we saw in April, they happen almost every year. Embrace them, stay calm, stay invested, and make sure your portfolio is set up in a way that you get a good night's sleep anytime you see a market correction. So keep your portfolio properly diversified, ignore the short-term noise, and stay focused on what your long-term goals really are. So thanks for joining me today on More on Markets, and I will see you next time.